Hello, my name is Charlie Wilson, and I am the owner of CPA firm Charles Wilson, Inc. And today we're going to talk about the new tax bill and how it affects businesses. There's a lot of complexities with this new tax bill, and hopefully we'll be able to answer some of your questions today with regard to the complexities. Minimizing taxes is all about planning ahead and knowing what the rules are. And so that is what we're here to do to help you. The Tax Cuts and Jobs Act provides for many changes to the business tax provisions. With a few minor exceptions, the provisions are generally effective starting in 2018, and the majority of these changes are temporary and will sunset after 2025. Due to the number of changes and also some new concepts introduced in the law, there is a need for guidance from the IRS and possibly from Congress in the form of technical corrections on the application of the law. There are also many questions about which states will conform to any or all of the federal changes. Here's an overview summary of the changes. We'll discuss these in more detail in further slides. The corporate rate is reduced to a flat 21%. There's a repeal of the corporate AMT, a new 20% deduction for pass-through income, loss limitation or other than C corporations. There's the repeal of Section 199 domestic production deduction, expensing of assets or the provisions for the bonus depreciation, expanded accounting method exceptions for small businesses, changes to various fringe benefits, including provisions for the meals and entertainment by the employer, no more carryback of NOLs, and an 80% limit on current year use of an NOL, 30% limitation on interest expense deduction for non-small businesses, and then finally, corporate shift from a worldwide to a territorial tax system. One of the major changes is the reduction of the corporate tax rate to a flat 21%. This is effective beginning in 2018. However, there are many businesses that are fiscal year returns that began in 2017. And so there's an alternative way to calculate the tax rate. In Code Section 15 provides information on how to calculate this. The effect is really a blended rate. If a business has AMT credits, they will be refunded from 2018 to 2020 to equal 50% of the excess of the credit for the year over the amount of the credit allowable for the year against regular tax liability. In 2021, the limit will be 100%, so all remaining credits will be allowed. The dividend received deduction was changed to reflect the new rate. The 70% dividends received deduction is reduced to 50%, and then the 80% dividend received deduction is reduced to 65%. Changes to the rate and other provisions also will need to be reflected in the calculation of the tax provisions for financial statements. Deferred tax assets and liabilities will need to be remeasured using the new 21% rate, as well as the evaluation of whether deferred tax assets will be realized based on the new changes. Due to the change mentioned earlier about the blended rate for fiscal year businesses, this will cause the remeasurement calculation to be even more complex. The new provision provides a 20% deduction on qualified business income. This deduction is taken on the individual's tax return for a taxable year, not above the line, but so it doesn't affect Social Security, but can result from the flow through of income from a sole proprietor, single member LLC, a partnership, or an S corp. The calculation is very complex and can be limited based on taxable income as well as the type of trade or business income that is applicable. The limitation based on W-2 wages and capital is phased in when the taxpayer's taxable income exceeds $157,500 for a single individual or $315,000 married filing jointly. A disallowance of the deduction with respect to specific service, trades, or businesses is also phased in when taxable income exceeds the threshold amount. These limitations are phased in if taxable income exceeds the threshold amount, but it is below $207,500 for single or $415,000 married filing jointly. There is a great deal of questions on how this deduction will be applied, and more guidance is needed from the IRS or Congress. Effective for years beginning after 12/31/17, a partnership will not automatically terminate if there is a sale or exchange of more than 50% interest in the entity. In prior years, if there was a change of 50%, more than 50%, the partnership terminated automatically. This eliminates the need for closing of the books to complete 2 tax returns, restarting depreciation lives, and maintaining partnership elections. The termination will only happen if the business is truly closing or if the ownership changes to a single member. The new tax increases the bonus depreciation to 100% for property acquired and placed in service after 9/27 in 2017. There is a new phase-down schedule for years after 2022. For the year 2017, if property was purchased and placed in service after 9/27, there's an election to apply the 50% bonus rate rather than the 100%. Another change is that the requirement that the original use of the qualified property must begin with the taxpayer has been removed. So both new and used property is available for bonus depreciation. The new tax law keeps or has increased to $8,000 depreciation for luxury auto placed in service in 2018. The depreciation limits for luxury autos starting in 2018 allows $10,000 for year of service, $16,000 for the second year, $9,600 for the third year, and so on. Section 179 has been increased to $1 million with a phase-out threshold of $2.5 million. With regard to accounting methods for small taxpayers, the law has expanded the availability of the cash method for small corporations. Cash method for C corporations less than 25 million on average gross receipts over the prior 3 years. Also, if met the 25 million threshold, the corporation can treat inventories as non-incidental materials and supplies if it conforms to the financial treatment of inventories. If the corporation met the 25 million threshold, the corporation is exempt from the requirement to allocate overhead to inventory as required by Section 263A. In addition, corporations with less than 25 million gross receipts can use the completed contract method if expected contract is completed within 2 years. Restrictions on interest deductions. The law places new limits on the deductions for interest paid on business debts for taxpayers with average annual gross receipts greater than 25 million. The deduction will be calculated as the sum of interest income plus 30% of adjusted taxable income, not below zero, plus interest attributable acquiring motor vehicles to be held as inventory for sale or lease. Special rules apply to the calculation of income for partnerships and S-corps. Changes to fringe benefits. The new tax law provides that no deduction is allowed for entertainment expenses. This includes any activity that is considered to be entertainment, amusement, or recreation, and includes membership dues for clubs organized for business, pleasure, recreation, and social purposes. Taxpayers may still generally deduct 50% of food and beverage expenses associated with operating their trade or business, but more guidance is needed on what this will mean for meals that are not related to travel. Taking clients out for lunches, etc., more clarification is needed. There were also several changes to fringe benefits. Historically, transit passes, pool van transportation, free subsidized parking, bike subsidy were excludable fringe benefits. Employers are no longer allowed to deduct these, except bicycle reimbursements. They are still excludable to employee if provided. Bicycle reimbursements are taxable to the employee but are allowed as a deduction. With the exception of active members of armed forces, exclusions from income for the reimbursement of moving expenses has been repealed for 2018 through 2025. Employee achievement awards for safety or length of service are no longer excludable from an employee's income. Section 132 excludes working condition fringe benefits for an employee if the employee could deduct the expenses as an unreimbursed employee expense. With the repeal of these expenses, it is unclear whether this exclusion is still available. Net operating loss provisions. For 2018 and forward, except in certain circumstances, specifically farming losses, the 2-year carryback has been repealed. The NOL carryforward period is indefinite, but only 80% of taxable income can be reduced by the NOL. This is another provision that may affect the calculation of the tax provision for the deferred tax assets generated by NOLs. Some other miscellaneous changes affecting businesses. The 1 million limit on executive compensation has been changed to expand the definition of a publicly traded corporation, and which will include all compensation. Primarily in the past, performance-based compensation was not included, and it will be now. The change related to 1031 exchanges removes the ability to trade personal property, so it is limited only to real property. A new rule imposes a 3-year holding period for a partner receiving a profits interest in exchange for investor services in order to receive the long-term capital gain treatment. The portion attributable to less than 3 years is treated as short-term capital gains, subject to ordinary income rates. There was no change in the allocation treatment of carried interest as has been discussed. For on-site eating facilities, rather than 100% deduction, companies are allowed a 50% deduction. After 2031-25, these expenses will no longer be deductible. Where certain lobbying expenses were allowed, the new tax law makes all lobbying costs non-deductible. This new tax credit, Section 38, is calculated at 12.5% of wages paid plus 0.25% up to 25% for each percentage point in excess of 50% of the employee's salary for which the employer provides coverage. The maximum amount of family medical leave that can be taken account of is 12 weeks. There are rules in place to determine who is an eligible employee for the credit. This is effective for years 2018 and 2019. Planning for 2018 and forward. Due to the many changes across the board that this new law contains, many of the planning strategies will need to be evaluated and examined to make sure that they still make sense. More guidance is needed on the application of the Section 199A and what it will mean for reporting for businesses' tax return. With the reduction of the corporate tax rate to 21%, this may cause a need for an evaluation of choice of entity for current and future business plans. For those businesses subject to interest limitations, there will be additional planning needed related to debt financing decisions. With changes to fringe benefit, exclusions, and deductions, businesses may make different decisions about company parties and benefits offered to employees. International changes. There are many complicated changes related to international tax. Just a broad overview. There is a new establishment for the participation exception system for taxation of foreign income, as well as a corresponding deduction for foreign source portion of dividends received by domestic corporation that is a U.S. shareholder of a 10% owned foreign corporation. These rules are very complex, and much more guidance is needed for affected businesses. Another new provision provides for a U.S. shareholder to include in income its pro rata share of the post-1986 deferred foreign income. The tax rates are 15.5% for cash and equivalents and 8% for the remainder of E&P. This can be paid in a 8-year installment period election. As noted, many more changes were made with the new tax bill that affects businesses with an international presence. Planning opportunities. So many decisions a business makes have tax consequences. Choice of entity, debt financing, changes to employee benefits, lease or buy equipment decisions, even planning a company party. Today we touched on the major topics at a very high level. With the complexity of the new tax law, it is a good idea to review how the tax laws affect your business. That is what we're here to help you with. Thank you for joining us today in our discussion of the new tax bill and how it affects businesses. If you have questions, please reach out to us, either send us an email or give us a call. Thank you.